we're good. Hi, everybody. So I've been getting asked a lot to report on the one big beautiful bill that's going through, that just was passed by the House and is now moving on to the Senate. But it's just, there's too much to unpack for an episode. I don't want to do a 1 minute report because there's just a bunch of shit that's going to get left out, right? So I thought it'd be better if we all watch it, or excuse me, if we all read the bill together. So I'm going to do a series of these. I'm going to take it 10 pages at a time. So today we're just going to look at the first 10 pages of the one big beautiful bill. And gosh, I hope you can read it here. Is it too small? If you're wondering what we're looking at, you can go to youtube.com/Kellerman comedy. I just want to make sure this is big enough to read. Let's make it like that. A little better. It is actually called the One Big Beautiful Bill. And I've seen a lot of like, oh, BBB is not. It's not the Big Beautiful Bill. It's the One Big Beautiful Bill. And there's a lot of stuff crammed into it. So that's why I want to take a look. So look, like I said, there's a lot to unpack here. So let's just take it 10 pages at a time. Let's take a look at. We'll start on page 1 here of the Big Beautiful Bill. This can be seen at waysandmeans.house.gov. So, Title 11, Committee on Ways and Means, section by section. The subtitle for this bill is the Make American Families and Workers Thrive Again bill. So, Part 1, permanently preventing tax hikes on American families and workers. That sounds good, right? Under the current law, the modified federal income tax bracket, schedule, and lower tax rates are set to expire on December 31st. That's the end of this year. This provision makes permanent the modified federal income tax bracket schedule and lower tax rates created by the Tax Cuts and Jobs Act, which Trump passed back in 2017. The provision also adds an additional year of inflation adjustment to all brackets except for the top bracket, 37%. So, here are the tax brackets. If you don't know, I believe 1 is the lowest tax bracket and 7 is the highest. Let's just confirm here. What is tax bracket 1? Right. So tax bracket 1 is the lowest federal tax bracket with a tax rate of 10%. So you can see, if you make $0 to $11,000 a year, you only get taxed 10%. And to be clear, this goes up. So this is for everybody. The first $11,600 you make every year gets taxed at 10%. Once you make over that first $11,000 still only taxed at 10%. But the next you make more than that, your next bracket gets taxed at 15%. So, as of right now, these tax rates and brackets look okay to me. I mean, I'm not I'm not a CPA or anything of the sort, but it looks like the people who make the most, which would be tax bracket 7, are taxed more than the people who make the least, which is tax bracket 1. So if you only make $11,000, then you only pay 10% in taxes. Someone just asked me if I'm wearing shorts. Nope. I'm a jeans guy. Really doesn't matter how hot it is. I'm always wearing jeans. Okay, so we'll call it section 2. Extension of increased standard deduction and temporary enhancement. Now, under current law, the increased standard deduction is set to expire at the end of the year. This provision makes permanent the nearly doubled standard deduction created by the Tax Cuts and Jobs Act. The provision further increases the standard deduction by including an extra year of inflation adjustment. Additionally, for taxpayers For tax years 2025 through 2028, this provision increases the standard deduction by an additional $1,000 for a single filer, $1,500 for head of household, and $2,000 for married filing jointly. The impact of these modifications to the standard deduction for 2026, according to the filing status, is summarized here. So this does look like an increase. So you can see single households under the current law have a standard deduction of $8,300, which doubles under the new provision. Head of household, $12,000 under the new provision, doubled, $24,000, $16,000 for married filing jointly. This is up to, I should say. These are projections of up to this dollar amount, right? Yeah, someone's saying I'm waiting to see a bunch of redactions. Just to be clear, this is what's been passed by the House. There are no redactions yet. The Senate will get a chance to make changes and all those things. But this is the bill as it has been passed by the House. Okay, so termination of deduction for personal exemptions. Under the current law, the deduction for personal exemptions is set to return after December 31st. This provision permanently repeals the deduction of personal exemptions. Now, that actually does not sound that good for us regular citizen taxpayers, right? Because we don't want the provisions permanently repealed. The deduction for personal exemptions. So let's just for clarification, what is the current deduction for personal exemptions? So the Tax Cuts and Jobs Act of 2017 suspended the deduction for personal exemptions for tax years 2018 through 2025. But tax exemptions are good. Let's see. Personal tax exemptions. Personal tax exemptions, which allowed taxpayers to deduct a specific amount for themselves, their spouse, and dependents, have been suspended. So at one point, this was like you just deduct $1,000 from what you make. If you make $50,000 a year, you were allowed to report and get taxed on $49,000 a year, right? At some point, there were these like personal exemptions. Families, homeowners were allowed to deduct a certain amount from their annual gross income. That has not been allowed since 2017 under the previous / current exemption status. Now this provision will permanently get rid of that forever. We'll just until we have a different president that does something different, we will not get any personal exemptions on our taxes. Section 4, extension of increased child tax credit and temporary enhancement. So under the current law, the child tax credit will return to pre-2017 levels after December 31st. This means that the credit amount will drop from $2,000 to $1,000 per child. The child Social Security number requirement will be eliminated, and fewer American families will qualify for the credit as the income phase-out levels return to much lower thresholds. Additionally, the $500 non-refundable credit for non-child dependents will expire. So, under the new provisions, they'll make it permanent. The doubled child tax credit of $2,000 per child maintains the increased income phase-out threshold and maintains the non-refundable non-child dependent credit. Additionally, the provision permanently indexes the credit amount for inflation beginning after 2026 and leaves refundable credit unchanged. So Furthermore, the requirement of the child's social security number for purposes of claiming the credit is maintained and expanded upon to require the taxpayer's social security number, and for joint filers, the spouse's social security number in order to claim the credit. The social security numbers provided must be considered work eligible in order to claim the credit. Additionally, this provision increased the child tax credit to $2,500 per year for tax years 2025 through 2028. Okay, so we're getting a larger child tax credit here, but it's only for people with who have valid social security numbers and work eligible social security numbers, which means this is what people are talking about when they're saying that it's cutting things for illegal immigrants. And I know a lot of people don't like the term illegal immigrants anymore. So what's the politically correct way to say undocumented immigrants? So if you and your spouse do not have a social security number or a work eligible social security number, you cannot get this child tax credit, right? Extension of deduction for qualified business income and permanent enhancement. So under the current law, an individual generally may deduct 20% of qualified business income from a partnership, S corp, or sole proprietorship, as well as 20% of certain real estate investment trust dividends and publicly traded partnership income. The deduction is limited to 20% of taxable income minus net capital gain. Special rules apply to taxpayers with taxable income in excess of the threshold amount, which for tax years 2025 is $394,000 for married taxpayers filing jointly and just under $200,000 for all other taxpayers. The threshold amount is indexed annually for inflation. For taxpayers with taxable income in excess of the threshold amount, the deduction for qualified business income is limited based on the W-2 wages and capital investment of each relevant business. Whether each relevant business is a specified service trade or business, both limitations phase in over a fixed range of taxable income, $100,000 for married taxpayer filing jointly and $50,000 for all other taxpayers. Due to the structure of these phase-ins, some taxpayers are subject to marginal tax rates close to 70%. The deduction for qualified business income is set to expire for taxable year. Okay, so a lot of these things are like expiring at the end of the year and have to be either continued or changed or forgotten, basically. Someone says child tax credit wasn't socialism? Sorry, I'm actually cut off here. Wasn't that socialism to MAGA? I don't understand the comment. Moving on. This provision makes the deduction for qualified business income permanent. For taxable years beginning after December 31st, 2025, this provision also increases the deduction percentage from 20% to 23%. Okay, so let's just go back up here. Under current law, an individual generally may deduct 20% of qualified business income. So they're raising that to 23% of business income. The provision also modifies the phase-in of the wage and investment limitations and the SSTB limitations. Under the provision, instead of phasing in over a fixed range of taxable income, these limitations phase in at a fixed rate, specifically for each dollar of taxable income over the threshold amount. A taxpayer's deduction for qualified business income is reduced by 75 cents until both limitations are fully phased in. Okay. Now, that's really confusing. Again, I'm not an economist. I'm barely a news guy. All right? So I'm just going to ask ChatGPT to explain this to me like I'm 5. Okay, so here's ChatGPT's explanation of that. There's a tax rule that gives some business owners a deduction on their income for their business, but not everyone gets the full break. Richer people start to lose some of the break when their income goes above a certain level. This is called a phase-in of a limitation. There are 2 kinds of limits mentioned. one that limits how much of your wages and investments can count towards the break, and one that limits people in certain service jobs like lawyers, consultants, doctors, and getting the break. Now, before, when your income went a bit over the line, the tax breaks started to shrink, but how fast it shrank was based on a fixed range of income that caused weird jumps in how much tax you owed, and some people ended up getting taxed at nearly 70% on those extra dollars that they made. Now, instead of using a weird range system, the IRS just says for each tax dollar you make above the cutoff, you lose 75 cents of your tax break. This is a more gradual and fair way to take the break away as income goes up, and it stops people from suddenly getting hit with massive taxes all at once. So, ChatGPT has summarized this as, if you're making more than the cutoff, the more you earn, the less of a tax break you get. 75 cents less for every dollar more. This makes the tax rules smoother and avoids crazy high tax rates for people near the cutoff. Okay, so this is what people are saying is a tax break for the wealthy, right? Because obviously they make more, and this is reducing the amount of tax that they pay over a certain amount. But it also makes it look like it just makes things clearer. It's clearer legislation, and sorry, I'm distracted by the comments here. Someone's calling other people weird, but I didn't see why. I didn't see why they're saying that. It is good for billionaires. I mean, it's good for everybody, really, but obviously because it's how many dollars are made beyond a certain cutoff, the people who make the more money are more likely to reach that cutoff sooner or at all. You know what I mean? So still, they're getting paid. The 70% of it all is remaining intact, you know? So I'm not seeing... Let's just ask ChatGPT, how does that affect wealthy people differently from poor people? Sorry, I know that's not the politically correct way to say it, but according to ChatGPT, poor or middle income people get a full tax break, no problem. You don't have to worry about the wage investment rules or the service job rules. You just get your deduction on qualified business income, and that lowers your tax bill. Full benefit, simple. Wealthy people, if your income is above the threshold, the IRS starts taking away that tax break 75 cents at a time for every extra dollar you earn. Eventually, if you make enough, the tax break disappears completely. Okay. Taking away the tax break. Okay, so if you're in a service job, the break phases out faster. If you may also get hit by rules that limit how much of your wages or business investment count towards the deduction. So wealthy people get less of the deduction, have to deal with more complex rules, and might face a higher effective tax rate on money earned just over the cutoff. Okay, according to ChatGPT, there is reduced or no benefit, just clearer rules. Summary: poor to middle income folks get the full deduction and don't have to worry. Wealthy folks lose the deduction as income goes up. It's taken away gradually, 75 cents at a time, so they pay more taxes on that income. Now, again, that was all very difficult for me to understand just by looking at the bill, right? So I understand why there's confusion about it. It is maybe even unnecessarily difficult to understand. But these are like, tax rules are weird. I just started my own business a couple of years ago, and business tax rules specifically are very difficult to understand. And I paid a lot of money in my taxes last year because I did not understand them. You know what I mean? So that's why I'm using ChatGPT to help me sort of like suss out exactly what I'm reading here. And ChatGPT is only clarifying what I input into it, right? I'm not asking it to find the bill or to find references for what the bill means. I'm just asking it to summarize and clarify this particular section of the bill. Right, someone's saying that tax loopholes completely negate problem for the rich, which is true, but you can't, I would say, that is true, but I don't know how many bills there are that there just isn't a loophole around. You know what I mean? People are going to find ways around the rules. We're just looking at what the rules are right now because there's a lot of confusion about the rules. Where were we here? So, increased individual alternative minimum tax exemption, blah, blah, blah. We just read that. Okay. Extension of limitation on deduction of qualified residence interest. Current law. Under current law, the deduction for qualified residence interest, also known as the home mortgage interest deduction, is set to increase from the first $750,000 in home mortgage acquisition debt to $1 million after December 31st. So it increases at the end of the year. This provision permanently lowers the deduction of qualified residence interest to the first $750,000 in home mortgage acquisition debt. So, if I understand that correctly, it looks like there's going to be an increase at the end of the year unless they stop that increase, and they're going to stop the increase. I'm going to use ChatGPT just to make sure that I understood that correctly. Oh, please explain. Right now, if you buy a house, you can write off the interest you pay on up to $750,000 of your mortgage on the interest. But after 2025, that was supposed to go up to $1 million, meaning people with bigger home loans could write off more and save more on taxes. With the new rule, it stays $750,000 forever. So if your mortgage is less than $750,000, you're fine. You still get the full tax break. If your mortgage is more than $750,000, you can't write off all the interest. You can only write off up to $750,000 worth of the interest. Again, this seems not extra beneficial to the wealthy. This part of it, at least, does not seem to have a more positive impact on the wealthy than it does the less wealthy. In fact, it seems like nothing changes for people who own a house that's worth less than $750,000, and is a little bit worse for people who own a house with a mortgage over $750,000. Moving on. Extension of limitation on casualty loss deduction. Under current law, the itemized deduction for uncompensated personal casualty losses resulting from a fire, storm, shipwreck, other casualty, or theft is set to return after December 31st, 2025. This provision will permanently allow for the itemized deduction for only personal casualty losses resulting from federally declared disasters. So what I think that means, and we're going to verify, but what I think that means is that if my understanding of what I just read is that if you start a fire in your own house, not covered the same way as if there is a nationally declared forest fire emergency, right? Then those things are covered a little bit more fully. But let's just see let's check our understanding, right? That's what we're here to do. We're checking our understanding. Please explain the following like I'm stupid. It really does dumb it down for you pretty well. So right now, if something bad happens to your stuff, like a fire, storm, theft, or insurance doesn't cover it. You usually can't write it off on your taxes unless it's part of a big disaster. But after 2025, the old rule was supposed to come back. That old rule let you deduct those losses even if it wasn't part of a major disaster, like if someone just broke into your house or your shed caught fire. So I did understand it correctly. So now it'll continue being that you can only deduct those losses if the bad thing happened in a federally declared disaster, like a big hurricane or wildfire. So if your stuff gets ruined in a regular accident or crime and it's not a big national disaster, you just can't write it off in your taxes. This has nothing to do with what insurance you have or anything like that. You just can't write off the loss on your taxes. But if it's part of a bigger disaster and the government declares it a disaster, then you can. Okay, moving on. Termination of miscellaneous itemized deductions. So under the current law, individuals will be under the current law, individuals will be permitted to deduct certain miscellaneous itemized deductions in taxable years beginning after December 2025. The provision permanently eliminates miscellaneous itemized deductions. So miscellaneous itemized deductions, from what I understand from my short time owning a business and filing taxes, is just what it sounds like. It's miscellaneous. It's things that you don't even have to like say like, oh, this was cars. Miscellaneous is like a catch-all for a bunch of random stuff. So this seems to eliminate that, which again seems not good for business owners, or at least it's not it's not a bill that favors the rich or something like that. Let's chat GPT it just to check my understanding. Oh, that's the wrong thing. How's everybody doing? Talk to me here. Is there something that you want me to look up instead? Tell. Are you having any feelings about what we're seeing here? So far, based on what we've seen, we're on page 9 right now, and it does favor the rich by harming small business owners. Are you talking about something that we have already looked at, or are you referring to something I haven't gotten to yet? Because so far, I haven't seen anything that hurts small business owners. Like, the most negative thing I've seen has been the cap on the amount you can deduct from interest on your home mortgage. The miscellaneous. Oh, I see. Okay, what we're looking at right now. So right now, something... nope, that's not what I want. Sorry, let's check my understanding. They're saying that who can afford a home mortgage anymore? Well, that's the point, right? That is sort of why I think that's kind of a good thing, because it's less favorable to own a home with a mortgage of over $100,000 if you can't write off the full interest on that, right? Hi, Stephen Liss. Okay, let's get back to this miscellaneous situation. So right now, you cannot deduct a bunch of small work-related or investment expenses on your taxes. That's right now, that's already. You cannot deduct a bunch of small work-related or investment expenses on your taxes, like fees you pay for a financial advisor, work-related travel or tools, union dues, tax prep fees. These are things that should be tax deductible in my personal opinion, but are currently not. Now, starting in 2026, those were supposed to come back. And this is saying that they're just permanently gone. They're not coming back. So before you could write off, before the Biden presidency, before the previous administration, you could write off small work or investment costs. Now you can't. Jay Mason says, I think us poors should get all the deductions, and the huge companies and billionaires should be the ones getting nickel and dimed. It seems backwards. I agree, but nothing in this bill, to me, seems like anybody's being nickel and dimed. Unless your problem is that the rules sort of seem to apply to both parties, both the rich and the poor. None of these things are, exempt to people who make a certain amount of money. These are things that affect everybody, but so far, most of this stuff only affects business owners, right? So even if you're a low-income business owner, most of these things affect you positively, just from what I've read so far. Moving on, limitation on tax benefit of itemized deductions. So under the current law, in tax years beginning after December, after this year, certain individual taxpayers will be subject to an overall limitation on itemized deductions known as the Pease limitation. In 2026, the Pease limitation is expected to apply to taxpayers with adjusted gross income above the following threshold, which is $339,000 and $339,850 for single filers, $373,850 for head of household filers, and $407,850 for married joint filers. A taxpayer subject to the Pease limitation is generally required to reduce itemized deductions by 3% of the amount by which the taxpayer's adjusted gross income exceeds the applicable income threshold. Additionally, the value of taxpayers' itemized deductions depends on the taxpayer's marginal income tax rate. For instance, generally, for a taxpayer in the 37% individual income tax bracket, each dollar of itemized deduction has a value of 37 cents. Interesting. That's a weird math thing here. This provision will permanently repeal the Pease limitation and replaces it with a new overall limitation on itemized deductions. The provision caps the value of each dollar of itemized deduction at 35 cents in most cases and applies only to taxpayers in the highest individual income tax bracket. This new limitation is effective for taxable years beginning after this one. So that seems like it is only for high-income people or the wealthy. And it seems like it's negative for those people. I mean, positive for all of us, really, but negative in that they don't get their, they don't get their little tax break or whatever. But let's just check our understanding. Okay, Pease limitation. If you make a lot of money, we're going to slowly take away some of your tax deductions. Here's how it works. If you make over a certain amount, if you make over $339,000 as a single person or $408,000 if you're married, the IRS says that for every dollar you make over that limit, we're going to cut down your itemized deductions by 3% of that extra income. So, rich people would lose some of their tax breaks, like for mortgage interest, medical bills, donations, etc. Also, when rich people deduct something, they save more money. For example, if you're in the 37% tax bracket, each dollar you deduct saves you 37 cents on your taxes. Okay, so forget the Pease rule. It's gone. Instead, there's a new rule just for the richest people. Your deductions still count, but no matter how high your tax rate is, each dollar you deduct can only save you 35 cents, not more. So, where it used to be if you were in a higher tax bracket, and I'll bring up the tax brackets again. So it used to be if you were in this tax bracket making what even is tax bracket number 7? Tax bracket 7. Tell me how much you have to make. Okay. Tax bracket 7 is for people making over $600,000 a year. So it used to be if you made over $600,000 a year, you were able to receive 39 cents back on every dollar because your tax rate was 39%. We'll use the new provisions, which is 37%. So you used to be able to receive 37% on each dollar. If you were in the third tax bracket, you would only receive 22 cents on each dollar. Now they're setting it at just an even 35 cents. No matter if you make more, if you make less, you will get 35 cents for every dollar deducted. Which again, that seems good for everybody. Obviously, the more you spend, the more those percentages, mean. But still, seems pretty good. What is the rest of my explain like I'm stupid have to say? So the old rule, if you're rich, we slowly take away some of your deductions. New rule, we let you keep your deductions, but if you're super rich, each dollar you deduct still only saves you 35%, 35 cents, not more. So you still get deductions, they're just worth a little less if you're rich. If you don't make that much money, that is an increase in how much you get back. So again, this doesn't seem to favor the wealthy. It seems to benefit everybody, and in this particular case, it actually seems to benefit the wealthy less. Moving on. Termination of qualified bicycle commuting reimbursement exclusion. Okay, this is for people who ride bikes. Under the current law, the $20 per month qualified bicycle commuting reimbursement exclusion received by an employee from an employer is set to return for taxable years beginning after December 31st. Someone's saying it says up to 35%. Let's ask ChatGPT to explain that part. So if I'm in tax bracket 2, do I still get 35 cents back for each dollar? You're right, it's up to. Only people in the highest tax bracket currently have the deductions capped at 35 cents. You're probably paying around 12% in taxes. That means each dollar you deduct save you... Okay. So it's just a cap on it, basically. You're right. Everybody doesn't get 35%. That's just the cap. There's no 37 or 39% for the higher tax brackets. So it is a small reduction of taxes, of tax benefit, only for the wealthy. So basically, if you make like under $500,000 a year, nothing changes for you. But if you make over that amount, you have less qualified deductions. To be clear, even though that doesn't benefit us normal people making under $500,000, it does still not benefit the wealthy. It is a cap on the wealthy only. Okay, so back to the bicycle commuting. This provision permanently eliminates the qualified bicycle commuting reimbursement exclusion. I'm going to check my understanding, but this one seems pretty straightforward. Basically, it seems like companies used to get taxable exemption or tax exemptions for essentially like promoting green travel, right? Promoting, like, employers were able to offer their employees $20 per month for riding a bike instead of driving a car, right? And that's going away. Let's just check my understanding here. Explain like I'm stupid. So right now, if your boss gives you a $20 a month to help pay for biking to work, and I have friends that do this, especially like hospital workers. I know that this is very common, or places where you have to pay for parking, even if you're an employee. So people will choose to ride a bike instead, and they have like programs to incentivize that, basically. Starting in 2026, that rule was going to change, and the $20 would become tax-free, like a little bonus for people who ride their bike to work, but that's not happening anymore. So basically, you can still get that bump from your employer for riding your bike, but but it's still taxable. It's sort of like taxing tips, I suppose, which that's all going to be later. But so you would have to pay taxes on that extra $20 bump that you got for riding your bike to work instead of driving a car. ChatGPT seems a little sassy to me right now. So this is the supers under the old plan. According to ChatGPT, under the old plan, you could get $20 a month for biking to work, and that would not be taxed. Now, according to ChatGPT, puts it like this: that deal is gone forever. If your boss gives you bike money, the IRS wants its cut. So yeah, bike to work, sure, but no tax breaks for it. ChatGPT's sassier than I am. All right, what's next? Extension of limitation on exclusion and deduction for moving expenses. Under the current law, both the exclusion for qualified moving expenses reimbursement and the deduction for moving expenses are set to return for taxable years beginning at the end of 2025. The provision permanently eliminates both the exclusion for qualified moving expenses reimbursement and the deduction for moving expenses, except for active duty members in armed forces. So I know that every time I file my taxes, it always, especially back when I used to do my own taxes, there's always a question towards the end that's like, we're looking for other exemptions we can give you. Have you moved anytime recently? And if you clicked yes, then you got a little bit of money back. But it seems like that is going away unless you are an active duty service member. I'm just going to check ChatGPT for my understanding here because I'm not the smartest guy in the world. I just want to make sure I'm saying these things correctly, right? I think I understand, but it's always good to check your understanding. That's kind of the point of my whole channel, right? People think they understand things all the time, and in fact, do not. So explain like I'm stupid. So right now, if you move for a new job and your boss gives you money to help pay for the move, you have to pay taxes on that money, and you can't write off the moving costs on your taxes. But starting in 2026, the old rules were going to come back, which were that you could deduct your moving expenses, and if your boss helped pay for your move, that money would be tax-free. But that's no longer true. So these moving-related tax breaks are gone for good unless you're in the military. Super simple version. It used to be that if you moved for work, you could deduct your moving costs or get tax-free money from your boss. Now, ChatGPT's so sassy. You can't and you won't ever again unless you're active duty military. So regular people moving for a job, no tax help. Military moving for duty still gets a tax break. And sure, this is the removal of a tax break for people who moved for their job and whatnot, but I don't know how much money that saves or loses people. You know what I mean? I don't know how many people annually, maybe ChatGPT knows, how many people on average benefit from tax deductions on moving for work annually. So before the tax cut, before the 2018 legislation, approximately 1 million to 1.2 million taxpayers claimed the moving expense deduction each year. This deduction was available to individuals who relocated for work and met specific distance and time requirements. However, the TCJA suspended this deduction for most taxpayers from 2018 and forward, limiting it to only active duty members. So this is already just the way it's been for the past 4 years. For the past, when was 2018? For the past 7 years. And now we're just renewing it. It's just going to continue being that way. All right, extension of limitation on wagering losses. Under current law, taxpayers can claim a deduction for wagering losses to the extent of wagering winnings. Other deductions connected to wagering may also be claimed regardless of wagering winnings. This provision permanently requires that all deductions for expenses incurred in relation to wagering also be limited to the extent of wagering winnings. I'm a little fuzzy on what wagering winnings are. So let's have that get clarified just a little bit. If you gamble and win money, it's literally, okay. Wagering winnings. Isn't that just winnings? If you gamble and win money, you have to pay taxes on your winnings, which I think we all knew already. That's been around for a long time. You're allowed to deduct your gambling losses, but only up to how much you won. So if you win $1,000 but lose $1,500, you can only deduct $1,000 in losses because that's how much you won. You can't use the extra $500 loss to lower your taxes. But some other costs related to gambling, like travel, hotel, or entry fees, could still be deducted even if you didn't win. So according to the new rule, from now on, all gambling-related costs, not just your losses, can be deducted up to how much you won. So if you didn't win anything, you can't deduct anything, not even your hotel meals or tournament fees. Interesting. Super simple version, old way. You could deduct gambling losses up to your winnings, but sometimes still deduct extra gambling expenses even if you didn't win. So you used to be able, if you like gamble for work, I guess, if you're joining a tournament or something, you used to be able to deduct your airfare or hotel stay and all that. You can't anymore. If you didn't win, you can't deduct anything. All gambling costs, losses, travel fees are only deductible if you win, and still only up to the amount you won. So if you don't win anything, you can't deduct any of your losses, which I don't know. I don't think that impacts wealthy people over poor people, but let's just ask. Let's just see what it says. Does this impact the wealthy differently from the non-wealthy? Yes, the rule does impact wealthy people differently from non-wealthy people, and here's the talk to me like I'm stupid version of how. This rule says you can only deduct gambling-related costs up to the amount you won. So if you win 0, you can deduct 0, right? So it doesn't matter if you're wealthy or not. If you don't win anything, you can't claim anything. Most average folks gamble for fun, and if they lose money, tough luck, they don't get any tax break. But they also don't usually have big gambling expenses like expensive tournaments, first-class travel, etc. So this rule might not change much for them. They were probably already getting little to no deduction. How it affects the wealthy people is that richer folks might do high-stakes gambling. They might have had big expenses, travel, hotel, professional fees, that they used to deduct even if they lost, and now they can't. So the wealthy lose a bigger tax benefit here. They used to get tax help for their big gambling lifestyle, and now they won't. So non-wealthy people weren't getting much of a deduction in the first place. Wealthy people used to write off a bunch of gambling costs, and now they can't unless they win more than they want to deduct. So big spenders will feel this more. So this is, again, something else in the One Big Beautiful Bill that does not positively impact the wealthy over the non-wealthy. All right. This is the bottom of page 10, so I'm about to call it quits here for the day, but this is the last thing we're looking at. Extension of increased limitation on contributions to ABLE accounts and permanent enhancement. So under the current law, the additional contribution limit to achieving a better life experience, which is ABLE accounts, which is equal to the lesser of 1, the applicable federal poverty level for a one-person household in the prior year, or 2, the beneficiary's compensation for the year, is set to expire at the end of the year. Now, this provision will permanently allow the additional contributions to ABLE accounts. The provision also provides an additional year of inflation adjustment for the base amount of the limit. Now, again, before I check my understanding, that sounds positive for the less wealthy. That sounds like it's not even something that impacts the wealthy at all, only positive for the less wealthy. But let's check my understanding here. So what's an ABLE account? An ABLE account is a special savings account for people with disabilities. It helps them save money without losing their benefits like Medicaid or SSI. It's like a special piggy bank that's just for people with disabilities. Now, what the current law says is that right now there's a limit to how much money you can put into an ABLE account each year. But there's an extra rule that lets the person with the disability add more money if they have a job. So if you have a disabled child or a disabled family member, we'll just say, you can only contribute a certain amount to their savings account every year. Whereas if they have a job, they themselves are able to add more, but the extra amount is either what they earned from working or the poverty level for one person, whichever is smaller. Hi, Nick. What the new rule says is the extra contribution option is staying forever. Also, they're giving the base amount, the normal limit before the extra, a boost for inflation, so it can go up a bit more over time. So as inflation rises, so too does the ability for you to add to this savings account for people with disabilities. So the super simple version is, the old rule was that if a disabled person had a job, they could put extra money into their ABLE account, but that deal was going to end at the end of the year. The new rule is that stays forever, and the regular limit can go up a little bit more each year. So if you're disabled and working, you can keep putting in more money forever, and your account can grow a little more each year because of inflation. Does this benefit the wealthy more than the non-wealthy? The short answer is no. This mostly benefits non-wealthy people, not the wealthy. Why? So ABLE accounts are meant for people with disabilities to help them save money without losing access to government help like SSI or Medicaid. But there are limits. You can't have too much money in the ABLE account or you lose your benefits. You can only use the account if your disability started before the age of 26. How the rules help. The new rules let people with disabilities who have jobs put in extra money beyond the usual yearly limit, which is a big help if you're working a low-paying job or you're trying to save for things like a wheelchair, therapy, housing, etc. Anything related to your disability, obviously. The wealthy usually don't need ABLE accounts because they already have savings and don't rely on benefits like Medicaid or SSI, so they can't really use these accounts in the same way. So again, this thing does not disproportionately help the wealthy. In fact, it only helps people who are on Medicaid or SSI, so that's good for the lower income people and not the wealthy people. So that's where I'm going to stop today. That was the first 10 pages of the One Big Beautiful Bill. I appreciate you watching with me. You know, it's complicated. It's really complicated. There's a lot of people cherry picking little things on both sides. Cherry picking little things, making them sound worse, making them sound better. I just want us all to be on the same page. You can't know without looking at it for yourself. So thank you for taking the time to take a look at it with me. I'll do the next 10 pages maybe tomorrow, but make sure you're subscribed on all the things. Make sure you follow me on Substack. I'm probably going to do at least one of these exclusively on Substack, if not more. So make sure you're following me at theforkinnews.substack.com. You can also just search Kellerman on Substack. Make sure you're following me on Instagram, TikTok, so you get the notifications ahead of time, and make sure you're subscribed on YouTube so that you get notified if I go live without notifying everybody. So thanks everybody for joining me. It lets me know you give a shit.